Welcome to our High Rock monthly video for April. I'm Scott Tomlinson, and with me on the call today is Paul Tepsich, the founder of High Rock and the portfolio manager. We have lots to talk about in March, and while we were battling the risks that were inherent with some of the banking situations that were going on, Paul was doubly balancing risk as he was risking avalanche in the backcountry of BC. So, Paul, you're with us, so that means that you managed that risk quite well.
I made it back, yeah.
Well done. And you enjoyed yourself out there as well, I imagine.
Yeah, it was phenomenal. It's great,
Right.
great trip.
Excellent. Okay, so let's move on because there's plenty to talk about today. We want to talk about banks and the banking system and what's going on there, what that means for interest rates as we move forward, and what the economic outlook is going forward as well. So we'll also talk about our latest portfolio adjustments, and then an update at the end on the tax document timelines. So let's look at March. March was actually a fairly volatile month, and that I think is shown best with what happened to the quality and safety assets like gold and silver. Bonds were also higher, and while stocks were down in the first third or the first half of the month, they did manage to recover. And we'll talk a little bit about what we did to take advantage of that. Just looking at it as quarter end, again, generally every asset class is up on the year. Stocks did bounce back nicely, as I said, in March, at the end of March, and that certainly helped balance portfolios. And we can see that year to date, our benchmark is up on a total return basis of about 5%. And just for reference purposes, I've added that it was pretty negative in 2022, and while it was positive in 2021, 2022 negated most of 2021. So we're still working on getting some positive returns into portfolios from a balance perspective. Paul, any comments on anything in the high yield mandate?
I guess one comment, I just wrote the note to those high yield investors yesterday. We continue to have still very strong or high weighting in fossil fuel energy bonds, but they are being called. We've got one of our bigger positions. We had 40% of it called in 2022, and then the balance is being called by the company, the issuer, at the end of this month. Another 3 weeks or so. So that although that trade has worked out really well for those investors, and in our balance mandates, we've owned some of those bonds. It's kind of bittersweet when they get called. You have to look to replace that yield with some risk that we feel is worthwhile taking. And you know, I won't go into performance wise, but it's still reasonably robust. So that's about all I would add on that front, Scott.
Excellent. Okay, that's great. Thanks. A reminder to everybody that our basic tenet is to look at your perspective, your situation from a long-term perspective, and we want to make sure that we're reviewing your circumstances, your strategy. So please, we're here. We want you to get in touch with us. It is quarter end, so we will be later this month sending out the quarter end client notes and summaries, and attached to that there will be an email that does ask you to get in touch to set up a conversation around your strategy. So if you would take note of that, it would be great. I appreciate that. Thank you. Paul, let's talk a little bit about what's going on in the banking system and how we see that weighing on the Canadian, the US economies, and even perhaps the global situation. You've been watching that really closely, and I'll turn it over to you just to talk a little bit about where we are, and what the impact is. I know that the Canadian banking system is more stable than perhaps this is the banking systems to the south of us because of a lot of the smaller banks. And why don't I turn it over to you, and you can maybe give people a little bit of an update.
Well, yeah, maybe I'll just do it in kind of two parts, and I'll do it very quickly and succinctly. But number one, what happened, people probably saw in the news, Silicon Valley Bank and one other Federal Reserve, I can't remember, Federal Republic, I believe, and probably a few other small ones that didn't even make the press. But if you look at Silicon Valley Bank, SVB alone, they had 100% of their deposits as demand deposits, which means you can pull it out the next day. Yeah. That's very dangerous from a funding perspective. And then they had very high concentration of depositors, a lot, obviously, in the tech space. So that's another risk. And then, importantly, from a regulatory point of view, they need to hold a lot of US Treasury bonds. But what they didn't have to do because of their size is they were able to hold those on their balance sheet at the price they bought them at, to maturity. Held to maturity would be the accounting term. So they didn't have to do what's called a mark to market. Now, what mark to market is in our portfolios held at Raymond James are mark to market largely every day, which means, if you buy a stock at $10 and it closes the end of that day at $10.50, it gets marked at $10.50, and then the next day, and the next day. So every day your portfolio is marked to where the market is. That was not the case with SVB. They held a pile of US Treasury bonds, and as most people know, rates a year ago and more were much lower. And through 2022, rates rose extremely rapidly and to a much higher level. And when interest rates rise, when I say rates, I mean interest rates, government bond yields rise, the price of the securities dropped precipitously. So when they saw a flight within, a matter of hours from their deposit base, they were forced to sell those Treasury bonds at a much, much lower price than where they originally bought them and where they that day had them marked. Boom. They were
now just to jump in just briefly here. The problem with owning those Treasury bonds is that they had maturities that were longer term, and as you said before, all the money they were borrowing from their depositors was short-term money. Right?
Yeah, demand, one night, one day.
So that short-term money wasn't matched to the maturity of the assets that they held.
Right, exactly. Yeah. It's a good point. So, and then I would just say, what's the effect of that? Well, I think number one, you could probably characterize it, quote unquote, the Fed broke something. They kind of sort of broke the banking system a little bit, and maybe just small pockets of it. I wouldn't say the money center banks in New York were broken.
Because short-term interest rates were raised so quickly, right?
Right, exactly. And another effect, which should seem pretty obvious, is that credit lending will now, well, I should go back. These banks were also, for whatever reason, specifically SVB, they were putting in deposits, overnight deposits at 50 basis points, or 0.5%. I mean, you could buy, even today, and they've come off huge, but you could buy a 1 month T-bill or government bond, US Treasury government bond, just under 5%. So why on earth would you take credit risk of SVB or any bank when at 50 basis points when you go buy something at 4.75%? So
well, and interestingly, I've had conversations with some clients and some prospective clients over the last few weeks, or even the last couple of months, about how they sit on significant amounts of cash in their bank checking accounts that earns absolutely nothing, when they could be, in fact, earning higher interest rates on a daily basis by looking for some of these high interest savings funds. And obviously we've been using those for our clients.
Well, that's a good point. So that's part of the reason why we're not overly concerned. One reason why we're not overly concerned up here, because our banking system is paying competitive rates to draw in deposits from investors. It's competitive with T-bills, government bonds, etc. That the situation down there was not. Now, the other effect, Scott, is that, and we should probably move on and getting too in deep here, but is that this is going to hurt the banking system in general down there, certainly in the medium and smaller banks and savings and loans, because they're going to be forced to pay a more competitive rate to bring in deposits, and they may likely they will be tightening up lending standards. So
yeah, and I think that's something that the some of the economic reporting we get from Capital Economics suggests that for both the Canadian economy, but more significantly for the U.S. economy. We'll get to that in just a second. But when they tighten those standards, that means not only has it become more expensive for borrowers from those banks, they also want significantly better collateral, right?
Absolutely.
And if you don't have that, and interestingly enough, and this is anecdotally, but I, just talking to a few people who are in the midst of home renovations, they're finding it quite a bit more difficult dealing with their bank. Their bank wants them to complete these things rather quickly, and sometimes that's out of their control, but the banks are pushing, and that in and of itself tightens what we call the credit standards, right?
Yeah, absolutely. And credit makes the economy go around, whether it's
Yeah.
the Fed injecting monetary policy, adding or fiscal policy, and certainly lending standards from the banks. That makes the economy move.
And then, of course, inflation's been another concern, which is why central banks were raising interest rates. Now, we have a forecast here from Capital Economics again that is suggesting that inflation should come down significantly over the course of the next 6 months or so. And that should allow, and likely will allow, central banks to start thinking about reducing interest rates and to take some of that pressure off the banking system.
Yeah, and this chart doesn't show it, but if you look at the last 3 months of inflation, both in Canada and the US, annualized month over month, and you annualize that 3-month level, you're just over 3% already. So it is coming down rather precipitously. Now, again, what we're looking at here is a forecast to the right of the dotted line, but nonetheless, we're really just over 3%. So I personally think that the bank and the Fed, the Fed already sort of broke the banking system. I think the next leg to fall may be the commercial real estate sector. That seems to be tightening up huge. There was a story yesterday about Blackstone, is probably the largest real estate holder in the US. They've been seeing redemptions on their real estate fund for 5 months, and they've gated it, which means you can't liquidate or sell your investment in that fund. Only a certain level will be allowed to be redeemed every month. So there are a lot of anecdotal stories out there about the commercial real estate sector. Something to keep an eye on. I think the Fed and the bank will be cutting rates by this summer.
Okay, and I think Capital Economics agrees with you to a degree. I think they think that the Fed will probably begin cutting in September. However, again, I think they do agree with you that there is a downside risk that you'll get the small banks and commercial real estate could force an even more significant tightening of credit conditions, and that in and of itself could be tantamount to pushing the recession from what they might call a softer landing to something a little bit more severe.
Yeah, I don't disagree.
All right, let's quickly talk about what we were doing while some of this was happening. As some of you know, we look at this fear and greed index as one of our metrics for determining when there are buying opportunities, and usually it's when there is more fear and people are selling. We want to be adding to client portfolios, and we were doing that a little bit with regards to our equity holdings for clients who have had recently added cash or had a little overweight cash balances. We did do some adding of some equity assets. We still have more we could add, and we'll likely be patient, wait for the recession to take hold and see if that does impact equity markets to the downside and create another buying opportunity. But we did do a little bit of buying in the equity space over the course of March when we did see a little bit more fear in the market. Since then, it's sort of rebounded, so we've stepped away. I'll let Paul talk about the tactical strategy.
Yeah, thanks, Scott. We had one new addition across the month. This position here, ACQ Auto Canada, which we bought, I think, on March 24th, which you can look up there. We didn't quite buy the bottom, but we got pretty darn close at an average price of 18.13. And we've had a nice little rebound. It's off a little bit today. But I think this is not a long-term hold. I think there are some problems with this company, but I think we can get up towards the 22 plus to 23 plus range, and we may just take profits there. We'll kind of reassess, but I think we can still move a bit higher. And that's unlike our Baytex position, which has come back a little bit. Everybody probably saw some news Sunday night. OPEC Plus has cut another 1.2 million barrels a day starting in May. So the price of oil popped up, and we did add some Baytex stock to newer clients down in the mid-4 range, which should work out pretty well for them. But again, that is more of a longer term hold. This chart here is a shorter term hold. There weren't really any other buys or sells, Scott, during the month of March, so we could probably move to fixed income. Fixed income. So first of all, the Canadian dollar was largely unchanged. Just kind of talk about that in the fixed income sector. As most people know, and certainly I've been writing blogs and talking on this video monthly, but we did start adding more interest rate sensitive investments back in, quite frankly, October, November. And we are, some of those were in the investment grade space. They trade very closely or correlated, highly correlated to government bond yields. We added a little bit in government bonds themselves, and some more recently over the past month or so. And then the other position we've been working on, which you've mentioned before, is preferred shares. Now, if you go back, folks, don't go back, Scott, but if folks go back, you can see the preferred share market has not performed all that well for the first quarter, and there's a reason for that, because about 75% of them, maybe 65%, I can't remember, of the preferred share market are what's called rate resets. They basically, most of those reset every 5 years. So when government bond yields increase, those preferred shares tend to do better. When they decrease, which government bond yields have largely been doing the past, especially longer dated government bond yields, the past, certainly the past month, with this so-called banking crisis going on in the US, those preferred shares do poorly. But given our overall view since October that rates had sort of peaked we have swapped out of our 3 rate resets. Well, we swapped out of 2. And still work in progress, but this has actually helped, saved us and actually added value. The 2 fixed rate preferred shares that we bought have improved, and quite frankly improved so much that we're getting a little greedier trying to buy them cheaper, but they don't seem to want to come down much because I think people have the same view as we do. We still own 1 rate reset pref, and we'll look to gravitate out of that one as well, but thankfully we got out of the other 2. That's a good recap on fixed income, Scott, and that's some of that is going back over a month, I know, but just wanted to highlight our view on rates.
Yeah, no, that's great, Paul. Thank you. And very quickly, just to recap a little bit on tax documents, they are available online at the Raymond James site. If you are wanting to get onto the site to get your documents, you can contact us if you are not able to log in, or if you've forgotten your password or user ID. We're happy to assist along those lines. That being said, if you need more assistance with your tax documents, we are standing by, and we're looking to help you if we can. And just an update on timelines, and you might be able to pause this just to look, but everything should be available now except for the trading disposition summary that most people want to have, that gives you your unrealized or realized gains and losses. So you may have to be a bit patient for that. Should be any day now, but you maybe have to be just a bit patient for that. But otherwise, everything should be available. Again, if you're having any difficulties whatsoever getting these documents, please don't hesitate to give us a call and let us help you. All right, that's it. Once again, thanks for taking the time to be with us on these monthly videos. We hope that we give you lots of good info on, and that's what you're looking for. Please always feel free to give us feedback. We're always wanting to improve if we can, so help us that way. But otherwise, on behalf of Paul and Diane, have a great rest of the month of April, and we will be back at the beginning of May.